despite the headwinds created by Brexit, the geopolitical and economic headwinds, there's been a significant amount of investment activity in the UK, both in central London and in the regions.
Over the last year, we've seen a lot of tech recommitting and expanding in London.
There's a lot of inflow of capital into the UK. Yields have come down. Most people are very, very, very bullish on the market.
The SME market has continued to be pretty strong. Seen a little bit of a slowdown more recently in London, but I think the regions have been exceptionally strong.
We're seeing more and more that the corporates are factoring co-working space into part of their portfolio strategy. We're also seeing that the corporates who are taking space with us are not looking at the space for a short-term option. They're looking at space with us as actually more permanent space for their departments. And then the final strand to it, I think, is that as the corporates are looking at who they're employing, they actually want those employees to be around like-minded people and like-minded businesses.
Changing consumer habits are having a significant impact on the real estate markets. You only need to look at Amazon building a 2 million square feet distribution centre in Bristol to recognise the impact on the physical landscape.
What we need from Brexit is some certainty and some confidence that the government is going into the negotiations and will deliver a good result for SMEs. If they have confidence that they know where they're going, then SMEs will adapt and they'll innovate.
I think the challenge of Brexit perhaps isn't Brexit per se, it's really whether the Conservative government will stay in power through their term or if they implode.
Our experience is that institutions are nervous of jumping into the market in a big way ahead of a trade agreement with Europe being agreed.
Really all we're asking for, I think, as an industry is to try and get some answers and some objectives as to where we're going.
Hopefully the government are able to show pragmatism over dogma and come to an arrangement with our neighbours, which is good for Britain and good for Europe.
The fact that you're seeing big businesses such as HSBC and Deutsche Bank moving a large part of their operations to Birmingham, for example, is a measure of how much change there's been. If you look at Birmingham with the retail developments at the Bullring and at Grand Central, at New Street Station, I mean, these are world-class facilities, and that fosters other investment.
The overseas investment so far has been limited to probably the top 6 cities, and overseas has really been investing in offices. Some Far Eastern investors have been investing in logistics, but I think logistics and offices will continue to be the attraction for the overseas investor.
And yields at the moment in London are at historic lows. You know, prime property in London is trading on around 3% net initial yield, which means you've got to hold the property for at least 2 years before you've got your purchase cost back. Whereas in the country or the regions, we can buy properties up at sort of 7.5% net initial yields, perfectly good office blocks, retail centres.
I think you're going to start to see in the regions this a similar offering that addresses the need for flexibility, as well as this very real need for user experience and a much richer experience within the workplace.
For next year, there's a lot of uncertainty in the market. Inflation is on the rise, the pound is dropping. I think the market is really changing.
So 2018 remains, I think, a very good real estate proposition to invest in. And then as you go out 2 or 3 more years later, it gets a bit trickier. If I look at the big issues that we worry about liquidity across Europe and the UK. We worry about consumer confidence. We worry about supply and demand dynamics. And then lastly, regulation and taxation.
The gauntlet has been thrown down, and clearly we're going to have to work a lot harder in a post-Brexit world to compete with the European cities.
But the good news is that with weak sterling, and that's likely to remain for some time, there is a significant amount of investment capital looking still to invest in the UK from all over the world.
Really over 2018 and into 2019, I think you're going to see, as the market becomes more sophisticated and a bit more mature, you'll see some consolidation within the market as the larger players look to absorb some of the smaller players. And I also think you'll see some casualties as well.
I see a ongoing opportunity in regional office buildings in the UK due to the lack of supply and also significantly increasing demand in the major regional centres.
As it stands now, they will continue. They've been a welcome addition to certainly the provincial market. They've been a large part of the provincial market in terms of the percentage of investment in our market. But I think in terms of what the rules and regs will be, I would guess that there will be a percentage limit as to what they can invest outside of their local area. I think industrial will continue to be the darling of the market for the reasons of increasing rents. There's a lot of drivers for that in terms of industrial. Obviously, online shopping, last mile delivery, click and collect. Everyone wants an industrial unit at the moment, so they are effectively in short supply with a lot of people wanting them. That is driving rents and therefore yields. And yields have come in substantially in 17, and I continue to see that in 18 for industrial.
The extended stay market in London is still very, very strong, and I think the short run as well as the long run, there's a huge opportunity there, especially if we compare with the potential which we see in extended stay in the US and Asia. We have to consider London and the UK and all of Europe actually as a very immature market yet. So there's lots of growth for us and our competitors.
On the build to rent, I think a lot's been written. We have seen 17, there has been progress. I think in 2018 we will see it as a serious sector for a number of the UK funds. Obviously M&G, L&G, LaSalle are at the forefront of it and driving it. I think some of the REITs will be dominant going forward. I think 2018 will be the year for build to rent. A lot's been written, but I'm convinced there will be action in 2018.
Well, the World Economic Forum last year ranked the quality of British infrastructure 28th in the world, and that's down from 19th in 2006. So if you want a measure of what needs to be done, that's a pretty good yardstick.
We operate quite a lot of centres throughout the north, from the northwest in Manchester right through to the Yorkshire and the northeast, and infrastructure in terms of transport across that area is key.
Cutting across from Manchester, connecting to Leeds and Newcastle, I think is a far greater priority to balance out the regional economies with London and the southeast.
I think as an industry, we need to have a united voice to continue to back strategic infrastructure projects. We've seen with Crossrail the positive impact that's had on business investment.
Between 2015 and 2017, we had just over 250,000 houses built, whilst we need to build at least that per year to satisfy the demand in the country. It needs a long-term political plan which is bought into by both sides of the Commons to focus on this as an imperative for the country, so that we make sure that we have enough houses for people to live in and we have the right capacity to attract the right talent into the right areas for the right jobs.